Imagine it's 28th September 2022. You are a 69-year-old central banker living in London, England. Your name is John Cunliffe, and before most people have finished their first cup of tea, you're already inside the Bank of England staring at a wall of bond prices. For years, your world has run on small movements. A few basis points here, a few basis points there. Tiny shifts in yields, tiny shifts in risk, the kind of numbers ordinary people never see and almost never think about. Outside, trains are running, shops are opening, retirees are walking dogs through quiet streets, and millions of workers are assuming their pensions are sitting somewhere safe, boring, and dull. That is the promise, after all. A pension is supposed to be the locked cupboard in the house, not the fireworks shed in the back garden. And yet this morning, the screen in front of you is flashing like a warning light on a sinking ship. If you have ever wondered how something as quiet as a pension fund can suddenly threaten the stability of an entire financial system, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, in different forms, in different countries, under different names. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. The 30-year gilt yield, the interest rate on a long British government bond, has jumped about 140 basis points in 3 days. That sounds technical. In plain English, it means bond prices have fallen with shocking speed. Pension funds that were supposed to be conservative are suddenly scrambling for cash. Some are receiving emergency collateral calls, demands for money right now, not next week, not tomorrow afternoon, right now. Estimates later suggest that pension schemes and their managers had to raise around 70 billion pounds of collateral and sold roughly 37 billion pounds of gilts into the panic. Within hours, the Bank of England steps in and eventually buys 19.3 billion pounds of long-dated bonds to stop the spiral. That was the moment a lot of people learned something they had never been told. The danger inside a pension fund is not always a stock market crash. It is not always fraud. It is not always some wild bet on a company no one has heard of. Sometimes the danger wears a suit, carries an investment-grade rating, and sits quietly in the bond portfolio. This video is about that hidden danger. Not because corporate bonds always explode, most do not. Not because pension funds are always reckless, many are not. But because history shows that when pension promises meet low interest rates, rising debt, hidden leverage, and the hunger for just a little more yield, something changes. The safe room starts storing gasoline, and by the time ordinary people smell it, the match is already lit. Before we go further, there is something important to understand. A pension fund is not just a pile of savings. It is a machine built to turn today's money into tomorrow's promises. Workers put money in, employers put money in. The fund invests that money so that years later, when a teacher retires at 65 or a civil servant stops working at 68, the checks still go out. That sounds simple. But under the floorboards, it is a balancing act. The fund has assets, which means the things it owns. It also has liabilities, which means the future payments it owes. Think of it like a bridge with people walking across from both sides. On one side are the retirees who need cash every month. On the other side are the investments meant to support them. If the bridge is strong, the traffic flows. If one side gets much heavier, the bridge bends. Bonds became central to this balance because they seemed predictable. A bond is just a loan. You lend money to a government or a company, and they promise to pay you interest and then return your money later. For pension funds, that steady stream looked perfect. But there were 3 hidden problems. First, when interest rates fall very low, safe bonds stop paying enough. Second, when managers reach for higher yields, they often move down the credit ladder into weaker corporate borrowers. Third, some funds do not stop there. They borrow or use derivatives, financial side roads that let them control more bonds than their cash alone would buy. That is leverage. It is like trying to carry 3 buckets of water with 2 hands. It works until one slip turns into a flood. This is why the phrase hidden bomb matters. The bomb is not just default, which means a borrower cannot pay. The bomb can also be a forced sale. It can be a ratings downgrade, which is when a bond moves from respectable to suspect. It can be a funding ratio collapse, which is simply the moment a pension fund realizes the value of its assets no longer covers its promises. It can even be a liquidity squeeze, which means the fund might still own valuable things, but it cannot sell them fast enough to meet today's demands. A pension fund can look calm on paper and still be standing on ice that is melting from below. One more piece matters, because this is where many viewers first realize why long bonds can be so dangerous inside retirement systems. It is called duration. Duration is just a fancy way of saying how sensitive a bond price is to interest rate moves. A short bond is like a short ladder. It wobbles, but not too much. A very long bond is like a tall ladder in high wind. A small gust at the bottom creates a big swing at the top. That is why pensions love long bonds when they want to match long-term promises. And it is also why they can get hurt so badly when rates move fast. Add corporate credit risk to that long ladder and the swing gets worse. If the company weakens at the same time rates rise, the bond is being pulled down by two hands instead of one. Now here is where it gets interesting. One of the clearest warnings came not in Britain, but in the Netherlands after the global financial crisis. Dutch pension funds were famous for being disciplined. They were large, professional, and woven deeply into national life. By the end of 2007, the average funding ratio of Dutch pension funds was around 144%. In simple terms, they had far more assets than the minimum they needed to cover promised benefits. It looked comfortable, it looked safe, it looked like the kind of system other countries should copy. Then 2008 arrived. Asset prices fell, equity markets sank, and at the same time, discount rates fell. That last part sounds abstract, but it matters. A lower discount rate means the future promises on a pension fund's books suddenly look larger today. It is like waking up and discovering that the same mortgage now counts as a bigger debt, even though the house has not changed. So Dutch funds were hit from both sides at once. Their assets fell, and the present value of what they owed rose. By early 2009, the average funding ratio had dropped to around 92%. The cracks that opened then did not stay on a spreadsheet. Recovery plans were demanded. Indexation, which means raising pensions in line with inflation, was suspended across many funds. That sounds mild until you live through it. If prices rise but your pension does not, you are taking a cut, even if the number on your check stays the same. It is like standing on an escalator that is going down while you are told you have not moved. Then came harder choices. In January 2012, Reuters reported that major Dutch funds, including ABP, PME, and PMT, were considering cuts between 0.5% and 7%. Those three funds alone paid pensions to almost 1.1 million retirees and managed pensions for millions more workers. In February 2013, Dutch regulator DNB said 68 pension funds would cut benefits from 1st or April 2013. The cuts would affect around 2 million active members, 1.1 million pensioners, and 2.5 million deferred members. Deferred members are people who had earned pension rights but were no longer contributing. The average weighted cut was 1.9%. 19 funds used the maximum cut of 7%. Notice what happened here. This was not a movie scene of traders screaming and glass towers collapsing. This was slower, quieter, more respectable. A pension fund did not have to blow up for ordinary people to feel pain. A retired school administrator in Utrecht did not need to understand discount curves to notice groceries taking a bigger share of the monthly check. A metal worker in Eindhoven did not need to read central bank papers to realize that years of work no longer bought the same retirement. The damage moved like winter damp through the walls. No bang, just a steady spread. And this is the first major lesson. In pensions, the threat is often not that a single corporate bond defaults tomorrow morning. The threat is that a whole system gets built on assumptions that only work if rates stay low and markets stay liquid. The system also requires sponsors to keep paying, and that nothing forces anyone to sell at the wrong time. Once those assumptions crack, even safe, bond-heavy portfolios can turn from anchor to anvil. Here is something I want you to think about before we go further. When you hear the word safe, what do you actually mean? Do you mean a bond that will probably pay in the end? Or do you mean an asset that will not force you into panic before the end arrives? Drop your answer in the comments, seriously, because what I am about to show you next is the part of this story that most people never hear. And it changes everything. This leads us directly to Britain in 2022, where the hidden danger was not just credit risk, it was speed. British defined benefit pension schemes had spent years using something called liability-driven investment, usually shortened to LDI. The name sounds cautious. It sounds responsible. It sounds like careful adults matching future obligations. And part of it was exactly that. The basic idea was to hedge the fund against moves in interest rates. Hedging protects the value of future pension promises. But because owning enough long bonds outright was expensive, many schemes used leverage. They used derivatives and repo borrowing. From 2011 to 2020, the amount of UK pension liabilities hedged through these strategies grew immensely. The value rose from about £400 billion to £1.5 trillion, roughly two-thirds of UK GDP. That is where the bomb was hidden. Not in a single reckless gamble, but in a respectable system. The system assumed markets would keep functioning long enough for everyone to adjust. It was like building a flood barrier out of stacked paper. On 23rd of September 2022, the UK government announced its so-called mini-budget. Markets recoiled instantly. By 28 September, the yield on 30-year gilts had risen by about 130 to 140 basis points in just 3 trading days. The move was so large that the Bank of England later described it as unprecedented. Pension funds held about 28% of the gilt market in early 2022, with heavy concentration at the long end. This was exactly where the price damage was worst. As gilt prices fell, leveraged LDI funds faced margin calls. Margin calls are emergency demands for extra cash when the value of your collateral drops. If the cash does not arrive fast enough, positions are closed. And here's the key point. When the calls came, pension funds did not have days to think. Some had hours. They had to sell what they could sell, gilts first. Then, many prepared to sell corporate bonds and other assets as well. This is how a pension fund can turn from steady long-term investor into forced seller. It is not because the trustees wake up and become foolish. It is because the plumbing of the system leaves them no choice. The numbers tell the story. Estimates later suggested that defined benefit schemes and LDI funds sold around £37 billion of gilts. Collateral calls were roughly £70 billion. The Bank of England launched an emergency purchase program on 28th of September. Over 13 days, they bought £19.3 billion of long-dated government bonds to stop the feedback loop. Without that intervention, a number of funds were heading toward net asset values so low that lenders could seize collateral. What did ordinary people experience? For most British retirees, the pension payment did not vanish the next morning. That is what makes this story so deceptive. The panic happened in the pipes behind the wall, not in the kitchen sink, but trustees were suddenly pulling cash from other investments. Unlisted assets were marked for sale. Portfolios were reshaped in a rush. A system built to think in decades was suddenly thinking in hours. When pension funds are forced to sell high-quality assets just to stay alive, the future gets a little thinner, even if the present check clears. The metaphor here is simple. Imagine a fire brigade that has to burn its own ladders to keep the engine running. That was the UK pension crisis. A structure designed to protect retirees had become so sensitive to market moves. It helped drive the very panic it was supposed to survive. There is another reason this case matters for our topic. Once a fund has to sell liquid assets fast, it does not always sell the exact thing that caused the problem. It sells the thing it can move. That means corporate bond portfolios can become collateral damage. In a real panic, labels stop mattering. Liquidity matters. The market does not ask whether an asset was meant for retirement safety. It asks whether it can be sold before the margin call deadline. This is where history gets uncomfortable. Once investors learn that even long government bonds can create chaos, they start asking a harder question. If that is true for government debt, what about corporate debt, where the borrower can weaken, get downgraded, or fail altogether? For that, we need to go to bank capital bonds, the part of the market that always looks ordinary until it stops. After the global financial crisis, regulators wanted banks to carry more shock absorbers, so taxpayers would not always be first in line. One tool created for this purpose was the additional Tier 1 bond, often called an AT1 or a COCO. These bonds pay higher yields because they can take losses fast in a crisis. The warning shot came in Spain in 2017 when Banco Popular was sold to Banco Santander for €1. Shareholders were wiped out. AT1 holders were wiped out too. The message should have been clear. These were not sleepy pension assets. They were more like trapdoors disguised as floorboards. But yield is a powerful storyteller. In a world starved of income, higher coupons can make risk feel reasonable. By 2023, many institutional investors, including pension investors, still held AT1 securities. Then came Credit Suisse. In March 2023, after a collapse of confidence in emergency negotiations, Swiss authorities pushed through a rescue sale. As part of that deal, more than $17 billion of Credit Suisse AT1 bonds were written down to zero. Zero. Equity investors still received something under the takeover terms, which shocked bondholders. In most people's minds, bonds are supposed to stand ahead of stock. The write-down became the largest loss ever inflicted on AT1 investors. For pension investors, this was not just a bad trade. It was a lesson in hierarchy. Many buyers had treated AT1s as enhanced income, a slightly spicier version of a bank bond. But in a crisis, they behaved more like emergency loss absorbers. Swiss pension programs were among those caught up in the fallout. The Ethos Foundation, which represents hundreds of Swiss pension schemes, was drawn into the wider legal storm. Years later, institutional investors were still weighing whether to pursue claims. The yield that looked like padding was a release valve. Ordinary people felt this more indirectly than in the Dutch case. A pensioner in Zurich did not see AT1 write down on the envelope, but pension funds that lost money on instruments like these had less room elsewhere. Lower future bonuses, more caution. In retirement systems, losses often arrive like a leak in the attic. You may not see it on day one. You see the stain later, spreading across the ceiling. And this is the third major lesson. In bond markets, labels can lie. Investment product names can sound safe long after the structure has become brittle. A pension fund may think it is buying income. In reality, it may be selling disaster insurance and not realizing it. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for. Now observe what all of these cases have in common. Different countries, different decades, different bond markets, same mechanism. In the Netherlands, the stress came through a collapse in funding ratios. Assets fell and liabilities swelled. In Britain, the stress came through leverage and liquidity. Long bonds fell, collateral calls arrived, and funds were forced to sell. In the Credit Suisse case, the stress came through structure and hierarchy. A steady income tool turned out to be a shock absorber. The same mechanism, different countries, different decades, same result. Pension funds do not fail the way casinos fail. They fail the way old theaters fail. The lights stay on, the front door still open, but the weight-bearing beams have been weakening for years, hidden above the ceiling. By the time plaster falls, the damage is already old. And what weakens those beams? The historical record points to the same pressures again and again. Low rates make safe bonds too thin to meet returns, so managers search for yield. Search for yield means taking more risk to earn a little more income. They move from government bonds to corporate bonds, from high-grade corporate bonds to lower-grade corporate borrowers. Sometimes they add leverage. Sometimes they add illiquid assets, things that cannot be sold quickly. Then a shock arrives. Rates rise. Credit spreads widen, which means investors demand more extra yield to own company debt. A rating is cut. Suddenly, the portfolio that looked diversified behaves like one crowded exit. This is why the phrase corporate bonds is a warning. Corporate bonds sit in the middle of every one of these pressures. They carry interest rate risk, which means prices fall when yields rise. They carry credit risk, which means prices fall when companies weaken. They carry downgrade risk. And when pension funds own them alongside leverage, the damage multiplies. The pattern becomes impossible to ignore. History does not say every pension fund is doomed. It says the danger is nonlinear, meaning it grows slowly, then suddenly, like ice melting under a truck. For a long time, nothing happens. Then, all at once, the weight finds the water. Look at what happened next. After the 2008 crisis, U.S. pension managers were already being pulled toward riskier credit. In March 2009, U.S. pension funds were adding more corporate bonds to portfolios once dominated by government debt. Investment-grade corporate yields were running far above safer government securities. Michael Archer warned there were not enough top-tier bonds. Funds might have to move into A or even BBB paper. That matters because BBB is the lowest rung of investment grade. One more step down and you are in junk territory where default risk rises sharply. The problem was arithmetic. Pension promises were still there. Safe yields had collapsed. Equities had just broken balance sheets, so managers searched for a middle road. But middle roads can become minefields when everyone crowds onto them at once. The World Bank found a similar pattern. As low rates pushed institutional money outward, investors favored larger, more liquid corporate bond issues. The share of emerging market corporate bonds with high face values nearly doubled. The market was building wider doors for money. Then the other shoe dropped. In 2022, the broad U.S. total bond index lost more than 13%. Long-dated U.S. government bonds lost nearly 40%. Those are not corporate bonds, but they teach a brutal lesson. Duration can damage portfolios that believed they were built for stability. Now add credit risk on top of that. Now add the possibility of downgrades, defaults, or forced selling. The floor becomes much thinner. This is who gets hurt most. Middle-class retirees who expected quiet compounding and steady payments. Workers too close to retirement to make up lost ground. Small employers asked to plug funding gaps with new cash. Towns and companies forced to divert money from wages or investment into pension repair. In any pension shock, the check feels cold first. This human cost is easy to miss. A city may delay hiring because contributions to a retirement plan have risen. A company may pay less into wages because it has to fill a funding gap. A retired couple may cut back on heating. The bond market looks abstract from far away. Up close, it shows up as smaller rooms and more fragile households. Who walks away better? Usually the people in institutions with three advantages: liquidity, simplicity, and realism. They did not build essential retirement promises on top of layered leverage. They did not assume the low-rate world would last. There's also a class difference. Wealthier households often have multiple cushions. The average worker often does not. When a retirement system takes a hit, the burden is not shared equally. It rolls downhill. The question is not whether this pattern will repeat. History has already answered that. The question is if you will see it. If this channel helps you think differently about the world you live in, subscribe. It costs nothing and might change everything. The historical record shows that those who came through these periods largely shared the same habits: liquidity, structure, and math. They kept enough ready cash that they were not forced to sell long-term assets during a panic. The funds that had room to breathe had time to choose. The ones that did not were dragged by the market. They respected structure. They understood that a bond is not safe just because it has the word bond in the name. An AT1 bond is not the same as a senior corporate bond. Survivors read the fine print the way sailors watch clouds. They respected math over hope. In the Netherlands, some employers made contributions, while other funds suspended indexation early. These choices were painful, but pain faced early is often smaller than pain denied. They adjusted assumptions when the world changed. Many of the winners accepted that boring can be a form of strength. In a yield-starved world, boring looks like underperformance. But history often rewards the fund that can still stand when everyone else is scrambling for the exit. A pension portfolio should be a seawall, not a speedboat. The job is to still be there when the water turns black. They also avoided confusion between solvency and survival. Solvency means your assets may be enough in the long run. Survival means you can get through this week. The survivors understood both clocks. They managed the decade and the day. What does all of this rhyme with now? First, the search for yield never really disappeared. The World Bank has shown how low rates pushed institutional money toward larger and riskier corporate bonds. Second, the lowest rung of investment grade remains dangerously important. Downgrades stop being just credit events. Third, higher rates have not removed the danger. They have changed its shape and exposed old losses. Higher yields make new bonds look attractive, but they strain borrowers with refinancing needs. The river is still a river. Return to that room in London on 28th September 2022. John Cunliffe is watching a market that was never supposed to move like this. Behind the numbers sit teachers, nurses, and office workers who will never read the Bank of England report. They only know their future depends. Corporate bonds inside pension funds are not automatically a hidden bomb, but they can easily become part of one. The explosion is rarely a Hollywood moment. It is usually a chain, a downgrade, a margin call, a forced sale, a suspended inflation increase, a lower future payment, a quiet letter in the mail. History is full of respectable compromises. The systems that feel safest are often the ones people stop questioning. That is when history asks its cruelest question. Safe for whom? Safe under what conditions? Safe until when? This is historical and educational analysis. It is not financial advice. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person needs to hear this, share it with them. Subscribe for more. And I will see you in the next one.